everybody, and welcome to the latest webinar with me, Andrew Dawkins, and
myself, Daniel Bajwoluk.
Someone
different.
Yeah, lovely to have you with us. Rachel's day off today, so wish her all the best for that.
Yes. Thanks for having me, Andrew.
You're very, very welcome.
Becoming a regular now, aren't I? Market updates. Yeah.
Okay. Star is born. So, what are we going to discuss today?
Yes, well, we'll have a look at the agenda first and foremost. So, as we always do during the webinars, we go through what's happening at A.R.D. Consultancy just now. So it's been a while since our last webinar, so there's a few things that have been going on. We move on to the market update for 2022, what's happened so far and what to expect going forward. There's a lot that's been happening since the turn of the year. And finally, the client question and answer session. So a few of our clients have sent in a few questions for you to answer a bit further down the line.
Great.
So what's been happening at A.R.D. Consultancy? So we'll go straight over to yourself, Andrew, to discuss tax year end.
Right. Okay. Well, I think this year has been the busiest year for activity as we get near to the 6th of April. So really, folks, the tax year for us is now complete, and that there's no other business we can now submit to providers, whether it's for pensions, investments, or savings. So it's been a very, very good year, I think, to sort of be investing and be sort of taking advantage of all the tax breaks that are available. One thing we would ask, this seems to be an annual plea, is anybody thinking about tax planning in the next tax year from the 6th of April, please start the journey a little bit earlier if you could. Make our life that bit easier. Thank you very much.
Well, I do enjoy seeing all the office scurry about come April time, though. That is a lot of fun.
Yes, but you have to remember, I have to pay the overtime bill that comes in.
So moving along then, sort of in conjunction with what you were talking about, new business.
Yes, well, we're pleased to say it's actually been a record-breaking year for us this year in terms of new business. We've picked up a lot of new clients, and I think primarily due to recommendations from you, our beautiful clients, who are referring friends and family to us, which is very, very nice to see. And it does mean that this year we've hit record levels for taking new business on the books, and also we've done quite a bit of top-up work to those people seeing it as a good opportunity really to move from cash and other investments that have not performed that well, and having a review and regrouping. So this year for us so far has been very, very good, and thank you to everybody for supporting us so well.
Looks like the sales and marketing is doing quite well as well, Andrew.
It could be. I wouldn't know who's in charge of sales and marketing, but
moving swiftly along, shall we?
You will tell us in a few minutes.
So here's a bit of a sad statement. We've got Alison McEnany, who's off to pastures new. So she's been with us for over 3 years now.
It feels a bit longer, doesn't it?
Administrative. No, not at all. It feels like only yesterday I remember meeting up with Alison, meeting her for the first time. But yes, she's doing something completely new, completely different. And I guess this is just a bit of an opportunity for us to wish her all the very best and thank her for the hard work that she's put in, all the hours that she's put into the office, and obviously helped us with the new business and everything that goes on with that. And I know that during her video there, she did mention she plays a lot of foosball, and she is the current foosball table champion, isn't she, as well? So,
well, I think part of the reason is that she's my partner on the table football, so that's probably got quite a lot to do with it then.
I don't know about that. I'm sure she's not here to defend herself or to differ. So she is quite the opponent on the old foosball table. But yes, on a serious note, we will miss her. But on the other end, a few of you may have noticed via social media and also online, website, a newsletter and whatnot, that we've been on the search for a new member of staff. And we had quite a few applicants that applied, over 130 that we had to mull through. Yes, so a lot that we had to get through. And fortunately, after a very prolonged period of time of interviewing and whatnot, we have been able to find a replacement that should be starting in a couple of weeks once Alison leaves, and her name is Maureen Scott, will be coming in. And just on that note, we may as well just have a review of the staff members that we've got working for A.R.D. Consultancy. So Top of the heap there, Mr. Andrew Dawkins is director, of course. Rachel Blackhall still with us, yes, compliance director. Stacey Borthwick, compliance support officer, been working very hard. And Maureen Scott, who will be starting in a few weeks' time, as we said. So you'll be hearing her lovely voice over the phone and hopefully meeting her when you come into the office. We've also had Rachel Conroy, who's been an administrator assistant, who's been helping us out for, how long has it been now? A few months, isn't it?
I have it, so since last October.
Has it? There you go. A few months. But she's also studying, so she's sort of part-time, couple of days where she's helping us out. Hence, she's administrator assistant. I believe she's studying marketing and French.
Ooh la la.
Ooh. So I believe she's going to do some marketing in France at some point. Is that what that means, Andrew? So, no help from Andrew, no. And then you've got myself at the end there. No, don't know for how much longer though. Sales and marketing manager. So move along. And it's still me jabbering on here. So we're talking about our partnerships here and a few things that we've done in the past. I think a lot of you would have seen via our newsletter. We try and do as much as we can within the community. And one of the pride and joys that we've had over the past 3 years now is sponsoring the Larbert High School of Hospitality. And that did begin back in 2019. So a lot of you will know Larbert High. And believe it or not, it is the second largest school in Scotland, Andrew. Pop quiz, which one's the largest?
Pass.
Oh, pass. Holyrood in Glasgow is the largest, but they're very close. It's only 100 odd students more, but Larbert High is the second largest in Scotland. So we're very proud to be part of that. And as I mentioned, we sponsor the School of Hospitality, which essentially introduces secondary students to the hospitality industry. And it wasn't still as a brilliant initiative. And everything was going exceptionally well until the dreaded COVID hit. And as we all know, the hospitality industry was probably hit the hardest out of any industry, which made things, I guess, even more difficult for the school and the students, especially when it came to doing their practical work, which was mainly in hotel settings and whatnot, which they weren't allowed to do anymore. Unfortunately, COVID restrictions also made it virtually impossible for us to further expand the partnership. However, we did stick around and we continued to support the students, and proud to say that we've donated over 180 personalized student aprons to the program, which you can see there in the photo over the last 3 years.
Did not take me a long time to make that.
You did well though. Quite the presser. Quite good.
Yep. Some of the names though took me by surprise.
Emma.
Yeah, that was easy to spell.
Some of the Scottish names, aren't they? So it's difficult for myself. But we've continued to invest time and resources into enhancing and supporting the pupil experience in the hope that it would act as a catalyst to inspire pupils going forward. And I've sort of mentioned there, we had some incredible ideas with Larbert High. And the hope is that with COVID restrictions beginning to ease, we'll once again begin to implement some of the ideas that we had discussed. And one of them, which you were quite a big fan of, was to organise a wee special function for some of our clients, whereby the students were to use their culinary knowledge and cook up a storm for everyone. So fingers crossed we can organise something like that later this year once COVID is done and dusted. And final thing there on Larbert High School is that we'll be making our official third-year partnership announcement on the 26th of April. And we're due to attend the school and distribute yet another batch of aprons to the newest members of the School of Hospitality. So stay tuned for more updates. So moving along, we'll go to what you're all here for, the market update, Andrew. It's been quite a 2022. So over to you.
Indeed, Danny. Yes, it's been quite a year, which sort of meant that really a lot of this year has been focusing perhaps on negative news, which is a result primarily of inflation around the world, not just here in the UK, but we've seen inflation figures from all over, especially into Europe, which is showing record high inflation rates. And this has led to really a sort of an imbalance between supply and demand. And all inflation is too many people wanting too few goods and services, and this causes prices to increase quite dramatically, as it's seen. And I think the real reason for this is the massive amount of money that's been pumped into the economy through central banks all over the world, noticeably in America. And this has meant that they have been able to support money markets and also preserve jobs in terms of job retention schemes, bounce back loans, etc. So we haven't witnessed the huge level of unemployment that we perhaps saw in 2007, 2008. So the schemes have worked. They've kept the money markets in cash, so liquidity hasn't been an issue. But now what we're into the position of is too many people have got money in excess of what they had 2 years ago, simply because of the fact we've been told what we can do, where we can go, and how we can spend our money. And this has led many people not to have gone on sort of spending sprees as they would do by going on extra special holidays or buying things, going out simply for a cup of tea with the family and friends when we've restricted as to the number of people we can meet. So the world is awash with cash. Those people that haven't been affected by COVID then have proportionately more money than at any point over the last 30 or 40 years. And this money needs to be spent. And of course, we're all coming out of the lockdown by and large at the same time, which creates then a huge demand. And we're still affected by COVID causing supply issues. So we can see the latest one over in China with Shanghai being locked down, millions of people there being told not to leave your homes. And this causes then difficulty with supply and will continue for some time to come. For the first time this year, we've actually witnessed a positive investment performance over all our portfolios and over the vast majority of the single investment funds that we recommend to our clients. I was looking back at the records, Daniel, and I haven't actually, since I've been doing this in 1893, I haven't actually seen a period where we've had 3 negative months in a row. So we saw negative January, February, and March is now up. So it shows a few. Yeah. Do you want me to give you a few numbers?
I think so. Yeah.
Okay. So we'll start with the 6 portfolios we run, but we'll talk about 4 of them. So the cautious portfolio this month is up 1%, and over the year up 1.5%, and over 5 years by over 25%. The balanced portfolio, so this has more equity exposure, up 1.8% over the month, up 3% over the year. These are all net of charges and fees, by the way. So what you'll actually witness if you were sat here doing a review with us. And over 5 years, up 37%. The capital growth portfolio, which interestingly is our largest portfolio with the majority of our clients' money invested in there, which is the equity components of around about 80 to 83% at the moment. Over the last month, up 2.4%, up 4.6% over the year, and 5 years up 48%. And then the final portfolio, which is the classed as aggressive portfolio, it's not really aggressive, but that's the name we have to give it because it has over 90% equities. That's up over the month 3%, 3.2% to be exact, and over the year up 6.8%, and over 5 years by 60%.
Assertive. I like the word assertive. Anyway, sorry to interrupt.
Now, the one fly in the ointment is the fixed interest investments. Now, we've been bleating on about this for the last 2 years, I think. So fixed interest, just a couple of words for debt. So it's debt, lending money to the government and lending money to the companies. Now, what's happened here is because of the supply of cheap money, which has been floating around since 2009, really, companies and governments are able to refinance at really cheap rates of finance. And so much so that a large number of fixed interest funds have gone negative. So therefore, they're reducing the value of returns over the shorter and medium term. So what we've been trying to do is move more clients away from fixed interest investments through to the equity side. At the moment, experiencing inflation hits fixed interest even harder. For example, if we're lending money to the US government through the Treasury, a year ago, if we gave them $100,000, we'd have an interest rate of around about 1% a year. Now we lend them the same $100,000 for 10 years. The interest rate, rather than being 1%, is 2.3 to 2.4%. So government's paying a lot more for their new debt as interest rates are perceived to increase because of inflation. And this is then another worry for governments, that if they're sitting with huge amounts of borrowing, at lower levels of interest, they're making a decent return. But with inflation kicking in, it means then they're now paying a lot more for their debt. So those contracts need to make sure that they can manage the debt and afford the repayments each and every month, which then causes the market some worry. Over the last month, the US has been the best performing of the sectors for our clients, and this reversal really is as a result of tech stock moving higher. They had a horrendous first couple of months of the year, but regaining some ground there. Employment levels in the US are at, the highest level since 1969. And interestingly, in the UK, many analysts believe we've now got full employment, shortage of labour in many markets. So the economic outlook is very, very good. Many of the companies that we hold shares in are delivering record performance figures, and the outlook is only slightly made harder because of the fear of inflation, lack of labour, and supply shortages. But the underlying where the economy is going is actually very, very good. One figure I got for all those people that said the UK was going to be finished after Brexit.
Brexit again. Here we are. Our good old friend. There's no image of Brexit on there.
No, at all. One interesting fact that came out was that the UK was the only developed country to actually increase the number of overseas students last year at universities and colleges. So I think that confounded quite a lot of people who thought that would be probably reversed. Global property was another good performer for March, and again it shows if you go for quality, people are prepared to pay that premium for it. So location. And that's the market overview, I think, for March.
I guess it sort of seems like we've turned a corner, and after January, February, you said to say, knock on wood.
Yeah, I think
not going to turn back.
It's all about uncertainty. So at the start of the year, the markets were very worried about inflation. They were worried about central banks, especially in America, cutting down the amount of stimulus that they're pumping into the markets. And these two factors create that area of, oh my word, I'm not sure what's going to happen next. Where should I be placing my money for long term? And that really then causes the markets to go into a wee bit of a panic. And we know markets, they over exaggerate movements. So when they panic, boy, do they panic, and for no good reason. Well, what we do is we look at those investment funds for our clients that only invest in quality assets without extra risk. So we're wanting to use assets that make money whatever the weather, and that's the key to it.
We sort of started, but the questions, here we go. So a few questions that have been posed by some of the clients and some that we've put together ourselves, but it's a nice little mix. So brace yourselves, everybody, because especially put your sunglasses on, especially for Andrew's shirt. But we are coming online, so we are on screen. And don't say I didn't warn you. So here we are.
That's a shout out for Marion Lewis in Northampton. A special request for an extra large shirt with nice stripy bits. It's quite good. It's the shirt I use for if I'm eating in an Indian.
Yes, that makes sense.
Spilling anything down.
Sumo.
Also decorating.
Yes,
it's a good one.
Camouflage.
Indeed.
Right. So a couple of questions we'll go through. So number one was from Chris. Are there any key points worth discussing from the spring budget statement by our good friend Rishi Sunak last week? Next question.
Really nothing of great note. It's designed to give you an update to the main budget. 5p cut in price of fuel, diesel and petrol, which doesn't really not much of a filling your car up, but I suppose every little helps. And the other one was class 1 national insurance contribution threshold increasing from just under £10,000 to £12,500 with effect from the 6th of July. Meaning most people in work earning £34,000 or less will be slightly better off in terms of taxable income, but then we're probably worse off because of the increase in fuel and heating and lighting and all the rest of it. So I think that was the only bit really to take out of the budget that was new. Everything else had been announced in the main budget from last year.
I like that little plug of Tesco as well. Every little counts. And as well, if you are looking to have a look at the statement in a bit more detail, then feel free to go on our website. We popped up on our world-renowned blog the other day, in-depth account of all that Rishi said. There you go. Next question, and this is the most popular question we've had. How is the Russia-Ukraine conflict affecting things?
Yeah, so directly, it's really having little effect. Because Russia isn't a superpower in terms of economic strength, then it doesn't have as much impact as if it was one of the major economies. However, it is a big exporter of things like fuel. And this has meant that it's adding to inflationary pressures. One way to try and get around that is to try and get fuel elsewhere. And one of the difficulties then is that the likes of OPEC are not really playing ball. They don't want to increase production any more than they're planning to, because they say they're not political and they have to react to demand and supply. There isn't a shortage of fuel around the world, it's just in the wrong place. So what's happening is that President Biden yesterday announced that he'll be giving the US economy probably will filter through to the rest of Europe an extra 1 million barrels of oil, which will be coming out of their reserves to try and reduce the price. So we've seen recently that oil has started to fall a wee bit, but still above $100 a barrel as we put this piece out. The other thing then, it affects things like commodities. Price of wheat, for example. The wheat exchange has increased by over 50% over the last 12 months. But it's got to be pointed out that all the major commodity indexes were increasing dramatically and increased so since January. But anything that threatens to reduce supply even further is not good for the economies of the world, because we rely so much on international travel and international trade. So directly, it doesn't affect things too much. Longer term, though, it's inflationary pressures, which, as we know, was the big challenge for this year anyway.
I knew I should have bought a couple of barrels of oil a couple of years ago when COVID hit. Andrew, we talked about that, didn't we? It was 99p a litre. Remember those days?
Yes.
2 years ago. So speaking about Russia there, so does A.R.D have any exposure to any Russian companies?
Not directly. So we don't invest in any companies that are listed on the Russian stock exchange, but we do have companies within the portfolio that deal in Russia. So, for example, Diageo, the manufacturer of Smirnoff and Guinness, amongst other brands, they've stopped exporting to Ukraine and Russia as a safety measure. And we've also seen the likes of BP and Shell give up their exposure to Russian development companies, and this has then led to the potential of reduced earnings, etc. But I think the likes of Shell and BP are making up elsewhere with the vast profits that are now being generated. Interestingly, I think we've never given advice on any single Russian investment funds. That there are funds out there. But we felt that, well, actually being exposed to something like Russia, just as we do to China, is a bit of an unnecessary political risk. So we've never given advice as well about any single company Russian funds. Similarly, we don't do that in China for ethical reasons, I suppose. But it's just an added level of complexity when you're dealing with countries like Russia and China, that sometimes you can't necessarily trust the figures that you're given. So there's an extra layer of complexity, I think, involved in those. So the answer is no, not directly, but indirectly, companies trading in Russia, and that could have some long-term effects, but not significant.
So you're saying I shouldn't invest in Aeroflot for my life savings that I just put in there a couple of days ago?
No.
Not a good idea.
Shame.
All right, so next question is from Bethany. As a result of this year's downturns, have you changed any of your investment fund options?
So in respect of the conflict in Russia and Ukraine. No, we haven't. We haven't made any changes at all because we design our portfolios and the funds that we recommend to our clients for longer term growth. Short term issues like this, horrendous as they are, they do occur from time to time within the world, whether it's health related or political unrest, etc. So we haven't changed anything directly as a result of this. As a result of the COVID, going back to that word again, COVID, as a result of COVID, we did actually make one change to our investment thinking, and that was to move out of UK property. And we used to use the Legal and General Property Fund, but that closed for business along with all the other UK property funds when lockdown was introduced because physically the surveyors were not able to visit the properties to put values on. So as soon as the fund reopened, and there are still some UK property funds closed to business, as soon as the fund reopened, we then advised all our clients to switch over to a worldwide property fund because the worldwide property fund is incapable really of being closed to new business or taking money out. So that was the one change that we did make as a result of COVID, but we're sort of fairly happy with the way that the portfolio sits, which is just investing in assets that make the money over a good period of time.
And next question is from Jeff, and I actually used this morning in my BNI meeting. I use this as an example. One of our clients said, I was planning to retire this year. Do I have to rethink my retirement date?
Very good. And what did you say?
Your answer there. I just copied your answer. It was great.
Yeah, and this is the first question we got at the start of the pandemic, I think as well from Michael, if I remember. So when we're helping people with the investment solutions, we're really looking over a long period of time. So somebody's going to be retired, and if we do a good job with their money, they're going to have money with us for life. Okay, you'll take money out for holidays, replacement cars, home improvements, that sort of thing, gifting. But if we do a decent job, then that money is going to be with us because there's nowhere else it could do any better. So if we take the short-term time period out of the horizon, and we say, right, okay, ignore short-term movements because we're always going to get that, then we say it doesn't actually disturb anybody's plans. So if your plan was to retire this year, and that's what we've been working with you to achieve, no, we don't change anything. Because if we did, it would mean that then we would have to say, right, okay, let's redesign things, and we'll come back and we'll start again. You retire, and then the investment fund falls in value again, which it will do, and then do you have to go back to work? No. So there are times when the investment goes up, times when it goes down, but it goes up more times than it goes down, and over the long term, then you see that's the benefit of it. So some clients we know, they don't use our app to value their investments on a daily basis or a weekly basis. They wait until they come into the office for their review. And for those clients, all those clients are seeing a positive return over where they were a year ago. For those clients that look at the app every other day, then you can see that the valuation will fall. And for January and February, when you've seen it falling day after day after day after day after week, then it starts to get people a little bit nervous. But we're forgetting the bigger picture, which is we're not bothered about the market volatility over a week or a month or even a year. It's the long-term returns that we're interested in. And if we go back to the original point, which is it's the long-term investment strategy, because you're going to be retired a long time, then you can say, well, actually, short-term falls in value are very good because that volatility drives the returns for the future. So volatility, prices coming down is very, very good for what we do because it means those investment funds that we use are able to buy assets at a cheaper price. As long as they're buying the right assets, which is not high-risk assets, then we make money. Was that the answer you gave this morning?
Pretty much. Yeah, that was it. Word for word, believe it or not. Another question here from Colin. Is now a good time to add a lump sum of money into my OEIC? Right,
okay. What do you think the answer is, Dan?
Yes, always a good time. Is that about right? I don't know. Is it a better time now?
I would say so, and that's probably highlighted by the fact that we've taken on more business over the last 4 months than most years we take into our control. People are seeing that the level of money that they're making in things like cash is very, very low. So if you're seeing the average cash rate something like 0.1% return a year, we've got inflation at 6.5%, or retail price index, which we used to look at 8.5%. You're making something at less than 1%, and inflation is eroding that buying power. So you're actually losing out. So cash then becomes a high risk investment, because most people's perception of risk is that they lose. So risk is I'm going to lose something. And when we look at inflation and cash, you're losing each and every year, but dramatically at the moment. So 0.1% against 6.5 to 8.5%, depending which inflation figure you want. So you have to look at other ways to make a return and to make your money preserve its buying power. And really, in our world, the only asset that's tradable and easy to sort of manage is company shares. So companies are designed to make money, to give back to their investors, to pay the workforce, to pay taxes, etc. And generally, companies adapt to situations. So you can find that companies can pass on, say, pricing increases if you've got a good company. So, for example, Apple can put up the price of an iPhone, and they're probably not going to lose many clients because of the fact people are committed to that brand. Diageo can put up the price of a pint of Guinness and know that they're probably not going to see any fall in the number of people drinking their product. As long as you're investing in quality, then you get that return. So companies are able to pass on price increases, very, very good. Companies that are squeezed in the middle, they have a challenge. If you can't pass that price increase on, you start eating into your reserves, and eventually the company goes backwards. So when we're looking at alternates, the big one really is shares, company stock, not only here in the UK but worldwide, but carefully selected, because that is capable of earning us the returns that we need to keep pace with inflation, and indeed beat inflation, as we can see with the figures that we looked at the start of the show. So it's never a bad time to invest. It really isn't a bad time to invest. We make money over those longer time periods, whatever the initial circumstances are. So yes, investing is good, as long as you can accept the fact that the investment will fall from time to time. So if you're uncomfortable with that, then we stay well clear of anything that's volatile and could fall in value. But if we're talking about falls in value, then cash is definitely a fall in value because of inflation eroding into it. And that's what we have seen this year. And more people looking at the cash accounts and going, oh my word, it didn't look so bad when I was getting 1 or 2% interest, but now it's 0.1, then that's not even going to buy me a cup of tea. So that's it. So yeah, invest away.
And I guess that confirms what you said earlier on as well with regards to the aggressive or assertive portfolio, where it's very much weighed into the shares, 95% shares, so a better way of earning, I guess.
Yes, I think one of the challenges we have is with the whole word risk. And then the way we have to classify it as aggressive, it sounds like we could lose everything, and it's not that way at all. The quality of company, generally, we don't invest in any funds that have more than 1% holding. So our biggest single company would be Apple, and in most of the portfolios, that's around about just 1% of the assets that we hold. Most of the companies are 0.8 or 0.7 of 1%. And it's those well-researched companies, both here in the UK and the US and worldwide, that deliver the returns we've seen. So the higher the equity exposure doesn't really mean the higher the risk. And unfortunately, it's the way, unfortunately, the media portray these things that, if you're investing money, it must be high risk, you can lose everything, etc. But you could lose everything if you've got money in cash against inflation.
It's a good opportunity to go up that risk level one little bit, potentially.
Well, this is what we've been trying to do over the last couple of years, but again, it's using that word risk.
Yeah.
It's sort of the profile. Profile. So cutting down exposure to cash, cutting down exposure to government borrowings, company borrowings, and then increasing selectively into the equity holding to make us that profit that we all want.
So we're almost at the end here. So I know you've touched on it already, but what are your thoughts on inflation, and when do you think it will come back under control, if ever, Andrew? Please.
Yeah. Inflation generally is bad because it destroys carefully put together plans. So for years and years and years now, we've been witnessing inflation of 1%, 2%, it's 3%, and now we're getting double that. And so it causes the markets turmoil because they don't know what's around the corner. It's a bit of a guessing game. It always is, but when inflation's on the cards, it's even more so. When it's going to end, how long it's going to run for? Well, I think it's probably going to be here for another 2 or 3 years until the supply matches the demand. And we can see that that's just struggling to be the case at the moment. We're all wanting the same things, and production lines have been affected by one thing or another, so it's probably going to be a good while longer. And it's fueled as well by the amount of cheap money that's been in existence. Increasing interest rates through the central banks, it doesn't really have much of an effect to many savers, especially those in cash rates, because you're not going to see your cash deposits suddenly increase to the levels where you're keeping pace with inflation. No, they're still going to be very, very low because governments can't afford cash rates to increase because of the huge level of borrowings that they've got, because then their interest rates become a lot higher and unmanageable. So cash rates are going to be low for a good long time. Inflation is still going to be with us, and it's trying to sort of work within that world that we're not going to be seeing 2% inflation for some time. It's the higher inflation figures. But as long as we've got assets that can adapt to that, then it's not too bad. I think it's very, very difficult for people on low incomes without the investments, without the savings behind them. Then the cost of living is the squeeze on people's household income and expenditure is going to be immense, and it's going to be very, very painful. Has to be said, the majority of our clients tend to be more affluent, and for many people, as we said right at the beginning, they're probably seeing that an increase in fuel price, okay, it's annoying, but it's not going to prevent them doing things and spending that money. So that increases the inflation pressure as we go. So increasing interest rates doesn't really lessen demand, but it does make it more expensive then for companies to invest. So when they're borrowing money, it makes it more expensive for them, which could mean then that there's a lack of research and development and lack of new facilities, etc. So it could actually harm the industries that we need to support. So I don't think interest rate controls by themselves really work. It's too much demand all over the world, because the economy fundamentally and people have never had it better. And that's the bottom line. We're doing too well.
I'm sure we'll all be feeling the pinch 1st of April, isn't it? It's the gas and electric, like today, isn't it? It starts today. Or somewhere along the line, I don't know.
I've never allowed the heating to be put on once. That's ridiculous.
That's true. We freeze. Final question, you'll all be happy to know that, which we've already touched on, Andrew, but the question is COVID still relevant? I think we wrote this question before the outbreak in China, didn't we? it's obviously, but over to you. Is it still relevant?
It is for the reasons we talked about before, because it disrupts the supply chain. So having 17 million people locked down in Shanghai just sort of goes to show what effect it can have. A major economic hub for distribution, export, and the money markets is being locked down, where we're carrying on our business most of the time unaffected, apart from having to wear masks.
Yes.
But so that's really COVID is still here, still an issue, because it just hinders that distribution.
Right. Well, that's it for our questions. So you no longer have to see a Tweedledee and Tweedledum anymore on your screens. You can pick which one's which. We'll go back to our lovely presentations. There we go. So, as you know, we had a wee competition that we staged to get some questions in. And drum roll, please, Andrew. What a fantastic effort there. Thank you, Andrew. The winners are, we've got two. It's Colin K and Jeff W. I won't say their full names, but we'll be in touch with the both of you to arrange the delivery of your fantastic A.R.D. Consultancy-based goodie bags. Isn't that fantastic?
I think we still have a number of piggy banks if anyone's interested in piggy banks, but you'll need to collect them. We're not posting those out.
So I think that's us, Andrew. We'll be happy to know we've used up enough electricity for everyone, so you can turn your electricity off, turn the boilers off, whatever you need to do to save all that. But it's been great to get back into it. It's the first webinar for this year, so we'll definitely look at scheduling a few more at some stage later this year. And as we always say, if there's anything that you want us to discuss, then please feel free to reach out. If you're here for a review, speak to one of us or Andrew as well with some ideas, and we're more than happy to facilitate those. Andrew, anything else from yourself?
No, just to thank everybody for joining us today, and wish you an enjoyable rest of the day.
We've also got a wee special. On behalf of everyone at A.R.D. Consultancy, we would like to wish you all an extra special Easter when it comes. And that's all yokes. You see, marketing. It's A1 5-star. There we go. But yeah, have a lovely Easter, everybody. Hopefully the sunshine stays the way it is. It just warms up a little bit. But thank you very much for joining us.
Yes, thank you very much. We look forward to seeing you next time.